In today's video, guys, we're going to discuss something fundamental. We're going to be looking at the time frame trade-off. Now, trying to understand the time frame trade-off will allow us or needs us to actually understand a lot of subsequent concepts like understanding basically imbalances. We're going to talk about what time frames are. We're going to talk about candlestick patterns, and we're going to finish off with discussing how time frames then are, in other words, also indicators, and how we use the time frame trade-off and how the time frame trade-off functions with us using multi-time frame analysis. Now let's get into things, guys, with the time frame trade-off. Now the first question we're going to want to ask ourselves about the time frame trade-off is, what is a time frame? Now, going into what is a time frame, we understand that a time frame, we are looking at a time frame right now. So we're actually drawing on the TradingView platform. On our right hand side, what we can see is price data, and on the bottom what we can see is time. So we know that a time frame is built up of two elements, time and price. Now we're going to go into one at a time. We're going to start off with price. Now, what moves price? We need to ask ourselves, what actually moves price? What makes price change and go either up or go down? We need to ask ourselves that question. And the only thing that moves price on a price chart are the volume of orders. Now, there are two types of volumes that could be spoken about, but we are not talking about the amount of orders. Like, for example, we're not saying 10 people are selling this market, so it's going to go down. We're not talking about the amount of orders or 10 orders are being placed. We're talking about the size of these positions. That's what moves the market. If there are 10 individuals that are looking to sell this market, and there is one individual that is looking to buy this market here, and this one individual is trading at 10 lots opening their buy, and all of these 10 positions here that are being opened here are traded at 0.01. All these 10 positions put together just gives us 0.10. Now we can clearly see that there are more lots being bought than they are being sold, and that's what moves the price, not the amount of orders being executed at a specific price point, but the size of those orders. If there is more size going bullish than there is going bearish, then prices will move up, looking for an area where there will be size being added on the sell side of things. So market will be going to look to balance itself out. So what we're doing right now is bringing in the concept of imbalance. That's what moves the market. The market is either in a state of imbalance or in a state of balance, either in an impulsive move, which is a state of imbalance, or in a corrective move, which is a state of balance. Guys, we are bringing in a lot of, this is one of the most informative videos, guys, that you will watch, and I hope that you do watch to the end. Let's get back to things and continue. So we are looking at balances and imbalances. That's what moves our forex markets. Now, to understand what balances and imbalances are represented by, how do we know that there's a balance? How do we know that there's an imbalance? One simple word, guys: candlesticks. That's what represents balance versus imbalance on our charts. We get to see what the volume of or where the volume of orders is flowing by the development of a candlestick, whether that's a bullish candlestick or whether that's a bearish candlestick. We get to see the volume of orders being sent through the market represented to us on our charts by our candlesticks. Now we need to understand as well the functioning of a candlestick. Now, every candlestick, for example, guys, this is a green candlestick over here. So all a green candlestick means is that price has closed higher than where price has opened. If we see here, this denotes our open. The low of the wick obviously denotes the low that price has moved. The high of the wick denotes the high that price has moved. And the close of this shows obviously where the bodies will begin and end. So the open and the close develop the bodies, the lows and the highs develop the wicks of our candlesticks. Now, because this candlestick is green, what it says to us is that price has opened lower and closed higher than where we initially opened. If the candlestick was red, then it would mean that price opened high and closed lower than where we opened. So that is obviously the coloring of our candlesticks, and they are showing us the amount of balance or the amount of imbalance that is in a chart, whether orders are flowing more bearish or orders are flowing, in this case, more bullish. So what we need to understand is that our time frames are shown to us, our candlesticks are shown to us on specific time frames. Now we're going to make an example here. If this was an H1 chart, so we're looking at the 1 hour chart, and this is one candlestick on the 1 hour chart. What does this show, or what can we just by using our general logic, we know that there are 60 minutes in a 1 hour chart. So obviously if we dropped down to a 1 minute time frame, what we would see is we'd see 60 candlesticks representing this data. So what we would see is the first candlestick opening here, we would maybe see prices moving lower to create the low. All these candlesticks maybe then pushing higher to create that high, and then closing back down where the candlestick closes. And within this period of 61 minute candlesticks, this data would be represented to us on a 1 hour chart by this one candlestick. Now, what we've just spoken about is showing us that the amount, remember, the candlesticks are just showing us the changes in price during a specific period of time. The changes in price do not change. So what we see, if price is moving up, price will move up on every single time frame. But the time frame that we look at, for example, the 1 hour or the 1 minute chart, will show us or shows us this period of information. So if we're looking at a 1 minute chart, we'll see 61 minute candlesticks representing this exact same piece of information. So what we just spoke about here, we know that we're looking at time. Now this is how we introduce the time aspect on our chart or on our time frames. So H1 period has one 1 hour candlestick. Now the same H1 period, if we're looking at a 1 hourly period, would have 4 15-minute candlesticks. And the same 1 hour period, if we looked at it on a 5 minute, would have 12 5-minute candlesticks representing that same piece of information. And like our example, if we looked at it on a 1 minute, this same 1 hour candlestick would have 61 minute candlesticks representing that one piece of data. Now this is how we come to the time frame trade-off. Guys, are you ready for this? Because this is absolutely going to blow your mind. If you've never looked at time frames this way, I'm about to expand your point of view on general time frames. Now, what we just discussed, as the time frames get lower, so we see this red candle, this red arrow here. So this denotes our low time frames, like the 1 minute. Now, as time frames get higher, this green candlestick will denote our high time frames. Just for this example, we'll use our 1 week time frame. So what we can conclude based off everything that we just spoke about is that The lower the time frame, the more noise we have. And as the time frames increase, what we see is the data begins to smooth itself out. So on a lower time frame, within the exact same period of time, you will have the same data on your chart, but with more noise. Looking at the same period on a different time frame will give us the same information but smoothened out. So the higher the time frame we go, the more the information that our time frame is showing us is being smoothened out. So what we can think about our time frames being like, we can think about our time frames like an indicator. Like the same way we use moving averages to smooth the information that we see on a chart to see whether information is, maybe we have a bullish trend when we see those moving averages pointing up. The same way we have moving averages to smooth our information, we can just use time frames. The higher the time frame we go, the more smooth our information would be. The lower the time frame we go, the more detail we'd have in our information. Now, I know that you guys have probably heard me say this a million times, that we always want to have 3 time frames that we reference our information from: a higher time frame, a middle time frame, and a lower time frame. What we are doing using this system is we are taking full advantage of the time frame trade-off. What we are doing by using our higher time frames is we are getting smoothened data. We are getting valuable data that has taken a lot of time to smooth. So the levels of structure that we find on our higher time frame are more valid because that information has been smoothened out. The trends that we find on these higher time frames are more valid because that information has been smoothened out. The middle time frame that we always use for our levels of structure, whether that's channels or whether that's horizontal supports and resistance, this middle time frame is giving us the opportunity to take advantage of the sweet spot, the spot in between the detail that we want from our lower time frames with the confirmation and the validness of these higher time frames. This middle time frame is our sweet spot. Most of our information we want to derive from our middle time frame. Now, the reason why we use our lowest time frame for our chart patterns and our entry confirmations, our candlesticks, is because the lowest time frame has the most detail. So what does this allow us to do? This allows us to refine our entry, refine our stop loss, still jump in on this important higher time frame structure, and then still jump in on our highest time frame momentum. So we're getting the validation of using higher time frame confluence, the sweet spot of middle time frame structure, and we're taking advantage of the detail to refine our entries on the lower time frame. That is our time frame trade-off. The time frame trade-off simply means that when we on our higher time frames, we are gifted, we are blessed with the validation of this information being smoothed out. We know that these are important support areas. Right there, we know that these are important resistance areas. We know that these are important support areas over there. We know that these are important resistance areas. Based off our higher time frame, we get a beautiful picture of the trend that has been going on, the trends that have been established. On our middle time frames that we might use, just for this example, I'll use the daily as our middle time frame. On this middle time frame, we're able to draw structure that is clear enough for us to be able to see. Also, structure that is valid enough on our higher time frames. That's what we want. Then we drop down onto our lowest time frame, and on the lowest time frame, we are gifted, guys. We are blessed. The time frames have blessed us with the detail of seeing what is happening within there. How can we refine our entries, isolate these chart patterns, narrow down points of interest for refined stop losses, but still trading higher time frame structure to catch the momentum that we're looking to catch? This is understanding the concept of our time frame trade-off, guys. Our time frame trade-off is just understanding that the higher the time frames we're looking at, the more valid the information is, and we can't really use this information to actually enter into the markets. Why? Because if we look at a moving average, let's just draw two moving averages that have smoothed price data. What are the moving averages doing? The moving averages are lagging. We'd find out that the candlesticks have already started moving up like that, and the moving averages are lagging. So that's exactly what the higher time frames are doing. The higher time frames, if we are looking at higher time frames for entry, we'd find that by the time price has already given us a bearish engulfing candlestick right here on our 4-hour, price has already moved like about 60 pips. Just making a hypothetical example on our smaller time frames. So the higher time frames are lagging, but what they do is they smooth out the price data for us. The smaller time frames are the time frames that we have accuracy because there is detail. So the higher the time frame we're looking at, the more lag we are experiencing, and the lower the time frame we are looking at, the more accuracy and detail we get to look at. So that's why we go off higher time frame structure but refine entries to lower time frames, guys. I honestly hope that you have understood and have taken in and have digested this whole concept of the time frame trade-off. And guys, obviously, if you've received that value, if you've learned something about the time frame trade-off, guys, definitely drop this video a like. Let me know that this information was absolutely valuable to you, because this took some strain out of me to actually put this concept into, or rather find all of the underlying concepts that make this time frame trade-off concept actually build up this time frame concept. So it took a lot out of me to actually put together all of these concepts to explain the time frame trade-off to you guys, because this was a concept that's always been in my head, but I never really understood how I can teach this concept to someone else. So anyway, guys, I hope that you appreciate the effort from me. If you haven't subscribed to the channel, then definitely do subscribe, because I'm definitely going to be sharing to you guys how we're going to connect and how we're going to break down this market, guys. We're going to go so deep on this channel. We're going to go as deep as possible. And I hope that you guys will be with me for this journey. Subscribe if you haven't. Drop this video a like if you enjoyed the content. Otherwise, this is me, T.Mayne, your FX Chasers mentor. I definitely will see you guys in the future videos. Enjoy the rest of your trading week and be profitable. Cheers, guys.